All right, Marty. How you doing, Marty? It's good to see you. Marty says, I know you use the 1% rule against the short put strike price, 50% triggers on 7 to 14-day expiration. What triggered was used for longer-term trades, say 30 to 45 days to expiration? Marty, the exact same ones, to be honest with you. What might happen, though, on a longer-term trade, I will be honest, we're going to take a look at one in just a moment. What might happen on one of those longer-term trades is it might be possible that you might hit the 50% loss, which is important. That's the most important. The 1% rule is more along the lines, Marty, of an alert that I use to say, hey, start thinking about doing something. Start thinking about rolling the spread. Or usually I don't like to do that, but start thinking about closing the spread. Start thinking about maybe closing the short, depending on how many time you have left, and leaving the long put option open in the case of a bull put credit spread, Marty, if I think there's still room for it to move down and I can turn a bull put credit spread into a long put and get profit if it meets my expectations of a continued downturn in that case. But it is possible that we could see a higher percent loss if the stock's only within 3 or 4% of the short call or the short put or the short call and a bear call credit spread and 10 to 20 days into a 30 to 45 day trade. The 50% is really my hard stop. I do not want to take a 60% loss. I do not want to take a 70% loss on the position. I can't allow that to happen. I'll illustrate why in just a moment. We've done it before, but it's always good to visit. So, what are we talking about here? Well, what we're talking about, for those of you that might not know, this is a standard bull put credit spread that came up. I think this is the Accenture trade that we were just looking at on the search results. And in this particular bull put credit spread, we'd be selling the 375 put, buying the 372.5, 55 at midpoint, 55-cent net credit at midpoint for a 28.2% return. That's probably not going to get filled at the midpoint. Again, the target should be around 16, 15% is what I'd normally see. What is the 1% rule? If the stock reaches within 1% of the short put strike price, in other words, $3.75 of my 375, so about 378.75, let's just call it 379. I'd put an alert on power options to notify me if the stock started trading, fell down to 379 from where it is now when I open the trade at 396. Actually, let's get a little bit better there. So 379, this would be my alert to say you got to start thinking about doing something. If tomorrow, if I entered this trade today, normally I'd open on Monday, but for example, if I open this trade today, and on Monday the stock fell to 379, I still have 11 days to expiration, I might be at a liquidation loss of 50% of this maximum risk. And if both triggers are hit, I'm probably just closing it. At 1%, I'm considering management, Marty, trying to figure out what's going on. But when it hits a 50% loss, I am out of the position. I don't want to risk it going any higher. Okay? Now, let's take a look at an issue here. I'm going to go to the portfolio. And I think I'm in this one here. So these are the three positions, the bull puts, that would have been opened on December 6th, close to mirroring what's in my portfolio. I'm not quite at the 1% rule here on this position. But here on this 2.5 Apple with 10 contracts, of course, the maximum risk, I should change it to 1 to be more clear. But anyway, the maximum risk would have been about 2,500 minus the net credit. We're not going to take that into account. Right now, I'm at a loss of 295, so it's around 10%. The other two are doing exactly what I want to do in these scenarios. Now, what would happen to this same position in this case if on December 6th, I have to write this down, my apologies, if on December 6th I had opened the January spread instead of the December 23rd spread at 165, 162.5. Okay, so how are we going to find that? Let's go to just the historical chain for Apple. And we're going to go back to December 6th on our chain. And, okay, that's going to go ahead and do that for me. And I just want to look at puts right now. And we are going to go ahead and go to standard January expiration a little bit more than you said, Marty, but hey, we'll do the 46-day out one. And what do oh, they didn't even have the 2.5 point spreads. That's okay. We're still going to sell the 165. We could have sold it for 658. Midpoint, we'll just use that. And the 160, since there's not a 162.5 right now, would have been at 465. All right, so let's enter that into the portfolio. And I'm only going to use one contract so we can see the numbers a little bit better, Marty. So let's go ahead and go to bull put credit spread. I'm going to enter in AAPL. Select our January 21st, now 35 days away. And the 165 put. We're going to buy the 160, I'm sorry. And same cycle, we're going to sell the 165. Okay, we're just going to use one contract here. Keep the math a little bit more simple. We're going to go to the 6th. The 6th, okay. And we could have gotten 6th, did I say 58? And 485, was it? 465 is what I wrote down. So I'm not sure which one it was, but let's go with 465. Okay, now, this position here, oddly enough, is still at a profit. I'm not at 1%, however. I might have to take a look at a different one there to see how they combine. So this one has seen some more time decay out of the options. We've gained about $2.40 here, and we've lost $1.90 here. So that's why I've got a little profit here of 50 instead of the loss on this one of 295 with the decline in the prices we could have gotten for that initial position. So what does this tell me? This tells me that even though we're not at the 1% rule, as we start to get close to that, my shorter term position is probably going to near the 50% loss where I'd close it, Marty. This one might not be at a 50% loss, but it still doesn't change the fact of what? Here's my 46-day out trade, now 35 days to go to expiration. We're at the 165, so naturally my stop would probably be around 166.70, somewhere in that range. My alert, Marty, my apologies. So right about in here, between the two strikes, 166.70 or so, right about in here. The 1% rule is still used. Why? Because what I don't want to have happen is to allow it to go in the money. I want to consider a management, rolling the short put down if there's a strike between. Maybe closing the short put, leaving the long put open, Marty. Maybe moving the whole spread down. Maybe converting if Apple's looking now that it's bearish more than bullish. And that is my outlook for the next 30 to 40 days. Maybe I convert this bull put credit spread into a bear put debit with a pendulum adjustment, or maybe I just close it and open a bear call credit spread to match more of the criteria. I want to do something, though, because I don't want this trend to continue where the stock falls below my short put strike price. I don't want to allow that happen. Even though it's not at the 50% loss yet, Marty, I still don't want to allow that to happen. Okay, I want to do something to this position before it breaches my short put strike price and move on. Okay, and that's what I'm looking for in that case. I'd still use the 1% rule as an alert. And yes, I still want to close the position at 50% of the maximum loss. Now, let me explain why. You've seen it before, but let's just show again why, because I think it's very important. And I had 2 coaching sessions this week where I had to discuss this. So I'm going to go to radioactivetrading.com. We're going to go to our little trade simulating tool. And so I go to radioactivetrading.com, click on the resources tab. And down here we see the trade simulator tool. And this is a simple tool which allows us to put in our target for the return that we're expecting, Marty, the loss limit we're going to take on what we allocate into the position, our probability of loss, setting our win ratio, the starting amount of capital, and the allocation to each trade, percent invested per each trade. So let's say that my target return is 14.5%. I'm going to put a stop. I'm going to use my 50% stop as the hard stop if I can. Sometimes it's 58%. Sometimes it's 42%. I think my average loss came out to 49.6, 49.7 on the losers that I take. Now, probability of loss, I'm setting at 15. That's the 85% win rate, 85% probability. Your numbers might be different, Marty. This is just an exercise into why it's so important. Just like we showed a moment ago for Pavel, we're going to take $10,000, let's say that's 10 to 15% of our portfolio perhaps, and we're going to use 33. We're going to open 3 trades per cycle. So I'm going to use 33% of that 10,000 into each trade. This tool is going to flip a coin. Heads, I win and I make 14.5% of that 3,300 invested. Tails, I lose 50%. And we're going to do it. It's random each time. So here's my 85% win ratio. Okay, write 85 times. So on the first trade, make up 14.5% with the 3,300. So we go up to 10,479. Another win, and this one is allocating it. This one is taking the wins and allocating it into the 33% each time. Now, then we get a loss. Ooh, drop down. Okay, have a loss about 4% there. So, and then so on, strings of winners and losers. But we see after 100 trades, we have very successful gain. We had about a 6 or 7% drawdown at one point, controlling it. I'm going to take the same numbers, Marty. We're going to stay at 14.5% target return, but I'm going to allow this to go to a 65% loss. Still 50% win ratio, still 33% allocated. Now we're still seeing some profits here at 89 and 90% success rate, of course. 78% success rate, you're almost bankrupt. I want to get to 85 as a fair comparison. I know 86 was close. It's random each time. I can't control that. Come on, buddy. 86 is close. I might have to stay there. 84. There we go, 85. On that last simulation, we saw that the high amount went up to about $44,000. The low amount was $9,600. Here it's down 30%. And the high, where we saw it about 33,000, I think 34,000 after 100 trades, keeping it at a 50% loss, is now only 14,000. That's still a strong return, don't get me wrong. But you see how fast this goes. If I don't close out with that 50% loss, whether it's a 30 to 45 day out trade, 50% of the maximum loss, whether it's 30 to 45, whether it's a 90 day out trade, whether it's a weekly, only 5 days out or 7 days out, I've got to control the losses. What happens if we let it go to 75%? I just forget about them and I don't stop them until they go below or near below both strike prices. Let's get to an 85 here, maybe even an 86. Here we go. At one point, still have a winning track record with a large strings of winners. Okay, one loss in there takes it down. You know, you're losing about $4,000 each time. You built it up to about 15,000 here, and it comes down to 10,800. It's huge. And then you go through, but 40% drawdown on the position. At one point, it looks like it's fairly profitable, and you end down about 25, 26% of your starting point. Same approach. 30 to 45 days, 90 days. You've got to control this risk to meet your targets. I want to keep it to about 50%. With mine, Marty, yes, it so happens that when I'm looking for those 2-week out or 11-day out spreads, usually if it hits 1% after the first 3 or 4 days in the position, or 3 to 4 days to go to expiration, it's at 50% of the maximum loss, and that's usually when I'll close. If it happens a day or two after, it falls 1% rule, a few days after the trade, Marty, I might look to manage first. It's not a hard stop, but 50% is extremely important, whether you're 5 days out, 15 days out, 30 days out, 90 days out, and so forth. So that's part of the trading plan that you want to be strong with there in that case, Marty, and you want to be able to do that as well. Okay, so 1% rule is a guideline. Not a hard stop. That's when you want to consider managing it. Again, you might want to consider 2 to 3% with those 30 to 45 days, but it also depends, Marty, on when it hits. If it hits the day after I open the position, if it hits 10 days after I open the position with 30, 45, or halfway, 15 to 20 days at 2%, it might be different. I think we did an analysis on that a month and a half or 2 months ago, Marty. I'm going to try to find that for you. I know we had this discussion with another investor where we were looking at something very similar to this about stops that would use for a longer term trade, and and we were discussing a 2 to 3%. That's why I'm throwing that number around, Marty. I'm going to look up that for you, see if I can find it, and I'll send you an email with that link if I find the webinar that I'm looking for there on YouTube. I don't even know what I would have called it, but I'm going to look through the webinars there. I'm not going to waste your guys' time doing that right now. Okay. And again, Trade Simulator Tool, go to radioactivetrading.com, go to resources, and then click on the Trade Simulator Tool, run your numbers so you can get a gauge of what your expected potential returns might be with your trading plan that you're working on, and tweak the numbers. Can I allow it to do X or Y? Do I need to increase the win ratio? Do I need to increase the return to meet the targets I want for the strategy I'm planning to implement in my portfolio? Okay, let's see here. This is another reason why I like this. Check this out. Not hitting my targets, only an 80% win ratio, but I'm still seeing a reasonable profit and a very tight drawdown with controlling the risk to 50%.